Good to have you here.
Thanks a lot, Oliver. Glad to be here.
How have things progressed since the last time we spoke? Because I'm looking at a market index, keeps making highs, but very sluggishly.
Yeah, the indexes have been pretty resilient. You think about the S&P 500, even now the equal weight version of the index, they kind of keep notching higher highs. That's encouraging. What's not as encouraging is if you look beneath the surface, it's not the same degree of participation that we saw earlier this year or late last year. You've kind of seen a divergence, higher highs in the indexes and kind of this drift lower beneath the surface to some extent.
So Willie, when does it matter though? If I just own the ETF, I could have slept through all this breadth deterioration. I've been watching it too, same as you. We've been talking about it since May really is when it started getting pretty notable. I mean, how long can it go on for? Can the market have this sickness in its stomach and never puke?
Yeah, that's a great question. I don't know that there's a time horizon to it. What we can see is that investors have stayed pretty optimistic, even as we've had these breadth divergences. And so I don't know that it definitely needs to resolve lower. I think what we could see, and the hopeful case would be, you have some digestion and then beneath the surface, things start to get back in gear. And you don't have that index level catch down. You have breadth actually catching up to what the indexes have been doing.
So Willie, we're looking at this sector level detail here. It's got three components that make up that trend indicator that we've been tracking with you: price trends, momentum, and breadth. So this thing, does it go more negative than it did a couple months ago? It looks like that doesn't happen very often. That was only during the really bad sell-off last year.
Well, in this time frame, yeah, that is we're about as weak as we could get. And so then the question is, if we get weaker than this, that's evidence that the indexes are catching down to what's happening beneath the surface. And just to step back, what we've seen in this index is that price trends at a sector level have been pretty resilient. We've run out of momentum at the sector level, and breadth at the sector level, it's kind of where we started, has been kind of discouraging. And so I think it's more of a risk that's out there than it is definitely a forecast. We will definitely catch down to what's happening beneath the surface. But I think it pays to watch this, because if we do start to see slippage from here, then that's a sign that rather than breadth catching up to the indexes, maybe the indexes catch down to what the broad market's been doing.
So another chart maybe shows this even more clearly. When you look at that trend indicator, you have a U.S. and global combined trend indicator. So I guess that's now including outside the U.S. But next to the S&P, as global as an index you can find. So it seems fair to me. Usually when this teal line, your breadth indicator, goes really, really far down, the index is not going very far up. You can see that in 2016. You can see it in 19, late 18 rather, and the hike concerns by rates there. And then you can see, obviously, in the COVID sell-off. This time they're going inverse. I mean, that's what we're looking at here, right?
Yeah, that's exactly it. What we're seeing is, and here we're broadening it out, so we're including the ACWI country level indexes in addition to the various industry groups in the S&P 1500. And yeah, most times when you have sustained upside moves in the S&P 500, you have things beneath the surface moving in harmony with them. So when the blue line goes up, usually the teal line goes up, to put it into very basic parlance. Right now we have the opposite. You could make an argument, I think, that we're still relatively high. And so even though we're off of our highs from a breadth perspective, we're not in the doldrums that we've seen in the past. But I still think if we're in an environment where the indexes aren't going to just kind of creep higher, but actually make a sustained move higher, then we want to see it beneath the surface. We want to see it globally in terms of participation, and not just a handful of U.S. stocks kind of leading the way and everyone else kind of begrudgingly coming along.
Willie, how long have you been compiling this? This chart goes back to 2015. Does that relationship hold? Is this the sample set that we've got for 15? Because I'm curious. It looks like 3 for 3 in the past. When your indicator broke down this way, market eventually came with it.
Yeah, we've been tracking it for over a decade now,
Okay.
and that has been the pattern. It's not a predictive timing sort of indicator.
I'm projecting.
But it does, yeah, it does give a sense of health, and that's really what we try to do a lot of times when we think about breadth. We want to say, how healthy is the rally? Do we have the ability to withstand a shock from somewhere? And when the rally is healthy, then and we have a lot of participation, then we absorb some of those blows. When we don't have that participation, that's when we're vulnerable to correction, and that's the environment that we stay in. So if we can get this turning higher, then I think some of the breadth concerns that we've talked about, others have talked about for a while now, start to move to the sidelines.
Willie, given that the index has sustained itself on the blood of the big tech companies, right? That's pretty much why we're getting that big departure as their market cap grows. Combining with the macro notes we had up on your view of the overall situation right now, that yields look poised to move higher. I mean, are we back into that situation where this becomes the biggest threat for the equity market?
Well, for segments of the equity market, yeah. For investors who have a lot of exposure to those growth names, those handful of stocks have really driven the S&P 500 higher. Yeah, higher yields are a definite risk. If you're looking at things like maybe the equal weight index or financials or some of the cyclical areas, then high yields are the opportunity you've been waiting for over the past few months, rather than a definitive risk that all of a sudden, because we have higher yields, that means the market needs to go down. The index certainly could have some body blows, but there are areas of the market that can benefit from high yields right now, and I think higher yields, and I think financials are a great example of that.
Willie, last one, taking that global market trend indicator and breaking it down, you've got three different parts: EMEA, Asia Pacific, and the Americas. Maybe this gives us perhaps a little bit of clue as to why the domestic index here has been so resilient.
Yeah, definitely. The Americas have been strong. Asia has been weak. What we're actually starting to see now is that EMEA is starting to improve. And so here we're not just looking at like developed Europe, but we're looking at emerging markets in the Middle East, emerging markets in Europe as well. And so from my perspective, that's an area, if investors are looking past some of the noise and saying, okay, given this outlook, what do we do right now? I think looking at Europe probably makes a lot of sense for investors right here.